Goldilocks environment. Most of the estimates that we read from investment banks, from analysts, are looking at an environment for 2024 that reads like a fairy tale. Not very good, but solid growth, no recession, no risk of inflationary pressures, and a solid environment of profits globally, particularly in the manufacturing sector. However, if we look at all of those factors, there are a number of things that destroy the narrative. And let's look at them in detail. Let's start with policy rates. The market expects between 5 to 7 reductions of interest rates from the major central banks in 2024. That massive cut in interest rates is completely incoherent with their estimates of growth. It's very simple. Either you believe in 5 to 7 interest rate cuts, and that means that there is a huge recession. That's the only thing that would drive such a massive interest rate reduction in an election year in the United States. Or if you believe that there's going to be low growth and disinflation and everything sort of soft landing, then there cannot be an environment of 5 to 7 interest rate cuts. And that's pretty evident in what central banks themselves say. They are showing that their objective is more to keep rates than to cut, and to cut very prudently, not 5 to 7 interest rate cuts in the middle of an election year in which obviously the opposition to the current administration would immediately say that the central bank, the Federal Reserve, is interfering in the electoral process. So it's very important to understand that expectations of rate cuts are misguided considering the environment. Either there is a huge recession, and then there may be some rate cuts, but certainly not 5 to 7. Furthermore, if there are 5 to 7 rate cuts, the impact on earnings and growth will be much more severe because central banks never act preemptively. And either you see rate cuts with recession, or you see less rate cuts with low growth. But don't bet on one thing and the opposite at the same time. Let's look at the next graph, because in the next graph, another important factor is the slowdown in China. China will be in 2024 again an economy that will be, for the first time, it was in 2023, it was the first economy in the world in which, in the middle of a big slump of the real estate sector, the economy grew adequately. And the key thing here is for you to understand that what the consensus is calling all the time, thanks for the graph to JP Morgan, consensus is calling for a huge stimulus plan, which is ludicrous. Why? Because one, they say that there is deflation. Two, because there's low growth. First, there are zero consumers in China worried about the reduction in prices. Zero. No consumer in China needs higher prices. They need more real disposable income. Number two, the problem of the Chinese economy comes from the excesses created in the period of enormous stimulus packages. It does not need another stimulus package. Actually, what it needs is less direct stimulus or so-called intervention. It's very, very simple. So the narrative is ludicrous. The example is the Eurozone. The Eurozone is a monster generator of allegedly stimulus plans and doesn't grow at all. No interest whatsoever in creating another bubble. Let's go to the next graph, courtesy of Bloomberg. This is the table of commodities. Commodities are showing us that the world is not growing in the Goldilocks environment that consensus estimates are showing. And think about this. look at the estimates of consensus with the reality of the price action in iron ore, copper, aluminum, even in oil or in natural gas. But in oil, with such an enormous level of geopolitical risk, oil is showing yet again a very poor price performance. And that is because the marginal level of demand is very weak. Gold remains stable, which is also showing that things are not as, let's say, solid, robust, or optimistic as some people expect. Pay attention to commodities. They tell you a lot about what is really happening in the world, not what we read in estimates. Let's go to the next graph, which shows us another important factor, because you say, okay, Daniel, that may be true, but markets are soaring to new all-time highs. Guess what is happening? Money supply is coming back, and it's coming back with a vengeance. We need to monitor this increase in money supply. In the last months, this is M2 based money in the United States. We need to look at this because it may be a very important trend. We're thinking a lot about rate cuts and rate changes, but we're not talking about liquidity. This is base money. Think about what we showed in previous occasions, which is net liquidity. Net liquidity is also rising quite fast. If this trend continues, the disinflation process may be wobbly, and markets seem to be discounting a level of net liquidity and a level of money supply that is much higher than this bump and this bounce that we saw in the last 3 months. Let's go to the next graph, courtesy of Bloomberg, which shows us another important factor, the dollar. The dollar is key to the current environment. There is a shortage of about 17 trillion of dollars in the world, with the requirements of emerging markets of new financing and refinancing of dollar-denominated debt, private and public. This massive deficit of dollars is also shown in a DXY index, which is fundamentally the dollar versus the euro and the yen, that remains very, very stable for a prolonged period of time, and it's coming back up in recent months. But this is relative to the yen and the euro. Now think about the dollar relative to emerging market currencies that require a very significant amount of new dollars to finance their debt. Remember, we are seeing liquidity coming back and coming back quite aggressively. So that may help short term, but there is still a shortage of dollars. And no, the availability of dollars doesn't have to be created by massive deficits, because the MMT crowd jumps in immediately. Absolutely false. The availability of new dollars should come from investment, from growth in the private economy, not from deficit spending, which creates worse growth and more problems for the US dollar in the future. Let's pay a lot of attention to that, because the current environment that we're seeing is a very clear environment of monetary destruction. No, the economy is not going well. No, the disinflation process is not enough, considering the destruction of purchasing power of currencies. And no, the dollar, commodities, and reality of the macro environment are not ones to suggest a Goldilocks environment. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.